Okay, today we're going to do a lesson on monetary policy, but before we do, and to set the stage for monetary policy, we're going to review fiscal policy. During periods of contraction, decreasing real GDP, to prevent recession, which of the following would be more appropriate government policy? Raising taxes or lowering taxes? Is lowering taxes a contractionary fiscal policy or an expansionary fiscal policy? During periods of expansion, to prevent hyperinflation and to decrease the national debt, which of the following would be more appropriate government policy? What should Congress do? Is raising taxes a contractionary fiscal policy or an expansionary fiscal policy? During periods of contraction, to prevent recession, which of the following would be the more appropriate government policy? What should Congress do? Increase government spending or decrease government spending? Is increasing government spending a contractionary fiscal policy or expansionary fiscal policy? During periods of expansion, to prevent hyperinflation and decrease the national debt, which of the following would be a more appropriate government policy? Increase government spending or decrease government spending? What should Congress do? Is decreasing government spending a contractionary fiscal policy or expansionary fiscal policy? Which of the following actions is more popular? Which do voters prefer that Congress do? Increase government spending on education, more help with student loans, increase spending on the military, increase spending on repairing roads, increase spending on responses to emergencies, or decrease government spending? Which do voters prefer? Increase spending on these things or decrease spending on these things? Which of the following actions is more popular? Which do voters prefer that Congress do? Raise taxes or lower taxes? What happens if a congressperson implements a policy that is very unpopular? The public will re-elect them and they will keep their job. The public will not re-elect them and they will lose their job. There have been several moments in our country's economic history when, during times of expansion, we could have reduced our national debt and could have slowed inflation if Congress had implemented contractionary fiscal policy. Why do you think that Congress chose not to do it? The nature of democracy is that a congressperson can lose his or her job for doing what is right. Doing what is best for the country can be quite unpopular, which leads us to the need for monetary policy. The Federal Reserve System serves as the nation's central bank. It is designed to oversee the banking system. It regulates the quantity of money in the economy. And the Fed was created in 1914 after a series of bank failures convinced Congress that the U.S. needed a central bank to ensure the health of the nation's banking system. The Fed is organized into a board of governors of 7 members who are appointed by the president and confirmed by the Senate. And they serve 14-year terms. And as a result, they are able to make unpopular, economically necessary decisions because they know they won't lose their job for doing what is right. Some qualifications of Fed's chairpersons: they tend to be Nobel laureate caliber economists. So they're generally more qualified than senators, representatives, and presidents to make economy-wide adjustments. And here we can see, following the Fed's learning curve during the Great Depression, following World War II, we can see the Fed really, truly stabilizing the economy by implementing monetary policy. Here, prior to the Fed's learning curve during the Great Depression, we see this constant high highs and low lows. So here is an example of the effectiveness of the Fed's monetary policy. We're going to watch this video. We're not going to watch all of it, but it's going to explain a little bit more of the details of monetary policy.
Welcome to Craft Course Act.
The Federal Reserve is the central bank of the United States, and it's commonly called the Fed. Europe has the European Central Bank, or ECB, and other countries have institutions that play similar roles. Most central banks have 2 important jobs. First, they regulate and oversee the nation's commercial banks by making sure the banks have enough money in their reserve to avoid bank runs. Their second job, and the job we're going to focus on today, is to conduct monetary policy, which is increasing or decreasing the money supply to speed up or slow down the overall economy. Monetary policy is what makes the Fed and the Fed chair so influential.
Let's start with interest rates. An interest rate is the price of borrowing money. When banks lend money, they expect to be repaid the amount they lent, which is called the principal, and a percentage of the principal to cover inflation and to make some profit. That percentage is called the interest rate. The number of car loans, student loans, home loans, and business loans that get made depends on interest rates. When interest rates are low, borrowers will find it easier to pay back loans, so they'll borrow more money and spend more. When interest rates are high, borrowers will borrow less and therefore spend less. In the US, the Fed doesn't have the power to tell banks what interest rate to charge customers. So instead, the Fed manipulates interest rates by changing the money supply. If the Fed increases the money supply, there'll be plenty of money for banks to loan out. Borrowers will shop around for the best deal on a loan, and banks will be forced to lower interest rates because they're going to have to compete, or else no one's going to borrow from them. A decrease in money supply has the opposite effect. Less money supply means that banks have less money to loan out, so they're going to try to get the highest interest rate possible. So less money, higher interest rates. If the central bank wants to speed up the economy, they can increase the money supply, which will decrease interest rates and lead to more borrowing and spending. That's called expansionary monetary policy. If the central bank wants to slow down the economy, they decrease the money supply, less money available will increase interest rates and decrease spending. That's called contractionary monetary policy.
Here,
Okay, so there are some details to monetary policy. How does the Fed increase the money supply, and how does the Fed decrease the money supply? It's quite complex, it's quite technical, and I used to try and teach those technical details to students, and only about 20% really understood it. And honestly, you don't actually have to understand these mechanics in order to understand enough to be an intelligent voter. All you do need to know is that the Fed, when it's trying to slow down a runaway economy, it makes the money supply smaller. And when the Fed is trying to speed up the economy, it makes the money supply bigger. Now, if you want the details of this, how exactly they do that, all the different tools they can use to do that, you're welcome to click through this PowerPoint presentation. I've given a link, made a link available to you. But the bottom line, what you need to understand about monetary policy tools that the Fed uses is ultimately their expansionary monetary policy increases the money supply, and that's in order to try and expand the economy. And they use these tools to contract the money supply if the economy is speeding up a little bit too fast, and they decrease the money supply, and that's how they try and slow things down. That's the basics of what you need to understand about monetary policy.